Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3, and this is Section B. This is an application topic. Calculate amounts of contingencies and prepare journal entries. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. What are you going to be doing on test day? You're going to be answering multiple choice questions and sims. Instead of watching hours of lectures or reading through whole textbooks, again, go straight to the thing that you're going to be doing on test day, multiple choice questions. And if you want to learn more about our strategies, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. We go over the key ingredients to passing the CPA exam, and again, it's only 1 hour, it is free, and we will teach you how to pass the CPA exam without wasting months or even years of your time. And after you watch that, you'll probably want to learn even more, so make sure you check out becoming a SuperfastCPA Pro member, because SuperfastCPA Pro members not only get access to the Pro course where Nate teaches you exactly how to study every day, but they also get access to the full 10-question versions of these 5-question videos. So if you like this and you like our other videos, you can get more of it by becoming a SuperfastCPA Pro member, because again, they get access to the full versions of these 5-question YouTube videos so that they can get more practice and more understanding. With all that, let's dive straight into the questions. All right, here we are at question 1, and something we always like to point out is reading the last part of the question first. This might not seem super useful in these questions because we're going over the same thing a whole bunch of times, but on test day, you have no idea what you're going to be seeing. You could see 50 different topics, so reading the last part of the question first gives you context quickly for what the question is going to be about so that you can more quickly look for what you need to know and more quickly calculate what you need to do. So again, you read the last part of the question first so that you have context going into the rest of the question. So let's start with that. According to GAAP, how much liability should Techland Inc. accrue on its financial statements at year end? Okay, let's go up to the top. Techland Inc. is involved in 3 separate lawsuits at year end, each with varying levels of likelihood regarding unfavorable outcomes. There's case A, where the attorneys have determined the loss is probable and estimate the amount of the loss to be $400,000. There's case B, where the attorneys have determined the loss is reasonably possible with an estimated amount of $300,000. And then there's case C, where the attorneys have determined the loss is unlikely with an estimated amount of $200,000. So with those 3 different cases, we have to figure out how much liability they need to accrue on their financial statements at year end. Now, this is something that's a pretty simple and straightforward topic. You may have already seen this before, or you may already kind of have an idea of how this works. If you know how it works, you probably already know the answer. If you don't know how this works though, again, that's okay. We are using these questions to learn how to do this material. So let's go ahead and dive into the answer to learn what we're supposed to be doing here. All right, here we are. The answer is A, they would accrue a liability of $400,000. So let's go through this. Contingent liabilities are pretty straightforward, as you'll see. Under GAAP, a liability for a contingency is accrued if the loss is both probable and the amount can reasonably be estimated. So look for that word, probable. That will almost always be the signal that this is an accrued liability or a contingent liability, almost always. But it also has to be able to be reasonably estimated. Let's go on to the cases to see why one of them would be accrued and the other one's not. Case A is probable, as it mentions, and the loss can be reasonably estimated because they gave an estimate. So $400,000 should be accrued for that one. Case B is reasonably possible, which requires disclosure in the financial statements, but no accrual is made. And don't get tripped up. They're kind of similar, probable, reasonably possible. Do not get tricked thinking that reasonably possible means that you need to accrue a liability. You only accrue a liability if it's probable. However, with reasonably possible, you do need to disclose it in the notes. So even though you're not making an accrual, you still need to disclose the possibility of that loss. And then for case C, this is unlikely or remote. You might see that word as well. So neither an accrual nor disclosure is required unless it falls under specific exceptions like guarantees of indebtedness or similar unusual circumstances, which those aren't what we're talking about right here. Now, you may see some questions that talk about somebody guaranteeing debt and then there being a chance of that probably being needed to be paid for the other person. So that would be another contingent liability. But overall, contingent liabilities typically deal with lawsuits and sometimes warranties and things like that. And we're going to be seeing that throughout the rest of this video. But again, remember, the most important thing and the most easy thing to remember needs to be both probable and reasonably estimated. Let's go to the next question. All right, here we are at question 2. How much should Pinecrest accrue for these liabilities in its year-end financial statements? Let's go up to the top. Pinecrest Industries faces 2 potential liabilities at year-end. The first liability involves environmental remediation efforts. The company's legal team considers the liability reasonably possible, with potential costs ranging from $500,000 to $800,000 but no specific amount within the range is more likely than another. The second liability arises from a workplace injury claim. The attorneys consider an unfavorable outcome probable, with potential losses estimated between $300,000 and $700,000, but no amount in the range is more likely than any other. So with all that information, we have to figure out, again, how much they're going to accrue for the liabilities. We already learned how this works, but now there's some estimate ranges, so we may not know how that works. If you have a guess, go ahead and pause the video. If you want to see how this works though, let's go ahead and go to the answer if you haven't already paused the video. All right, here we are. The answer is B, $300,000. So let's go through this. Under GAAP, contingent liabilities must be accrued if they are both probable and the amount can be reasonably estimated. We already know that. When a probable loss is estimated within a range, but no specific amount in the range is more likely than another, the company accrues the lowest amount in the range. So that's the rule when it comes to ranges. If it is probable and then they have an estimate range, you use the lowest part of the estimate range if there's no best estimate. However, if there is one amount in the range that is more likely than the rest of the range, that is used for the accrued liability. So even if you get a range, but they say out of this range, $400,000 is the best estimate, that's the best estimate, and that is the amount you use for the accrued liability. Again, if it's probable. If it's not probable, then we're going to treat it a little bit differently. So let's look at the two different ones. For the environmental remediation liability, the outcome is reasonably possible, not probable, so no accrual is required. However, the full range of the estimate, so the $500,000 to the $800,000, must be disclosed in the financial statement notes. So if it's only reasonably possible, meaning it does need to be disclosed, you don't disclose just a specific amount. You don't disclose the lower of the range, the $500,000, like you would if it was probable. You disclose the full range. So you disclose the $500,000 to the $800,000. However, let's go to the second one. For the workplace injury claim, the outcome is probable, and the range of the loss is $300,000 to $700,000. So since it's probable and there is an estimate range, and we already know the rule, we read it just before, since no amount within the range is more likely, the lowest amount in the range, the $300,000, is accrued. So that's the amount of the accrual for this contingent liability. Again, if it's probable and there's a range, you use the lowest part of the range if there's not a best estimate. However, if there is a best estimate, that's what you use. But even if there is a best estimate and a range, if it's only reasonably possible, then you disclose the range and the best estimate. So there is a difference there. Let's go to the next question now. All right, here we are at question 3. How much should Evergreen accrue for its contingent gain in its year-end financial statements? Evergreen Enterprises is involved in a legal dispute over patent infringement with a competitor. At year-end, Evergreen's legal team believes that a favorable amount is probable and the company is likely to be awarded damages ranging from $400,000 to $700,000 with a best estimate of $500,000. How much should they accrue for this contingent gain? So we've learned a lot about contingent losses up to this point. Does it apply the same way? Go ahead and pause the video and think about this if you want. And when you're ready, come back. We will look at the answer together. All right, here we are. The answer is A, $0. You probably had that guess just based on some of your knowledge from accounting, but if not, that's okay. We're going to talk about it. Under GAAP, contingent gains are treated differently from contingent liabilities. While contingent liabilities that are probable and reasonably estimable must be accrued, contingent gains are only recognized in the financial statements when they are realized or become virtually certain. Remember, looks like I misspelled that there. Sorry about that. Remember, GAAP is always conservative when it comes to gains and liabilities. And when I say conservative, I'm not talking about, political parties or anything like that. I'm talking about how losses and gains are treated under GAAP. When there's a possibility of a gain, we don't record it until it's for sure a gain, until it's realized. But because we're trying to be proactive and preempt bad things happening, if there's a high chance of a liability happening or a loss happening, we might record that. Again, that's what that would mean there if it's conservative. That's why we don't record this gain. In this case, although the favorable outcome is probable, the gain cannot be accrued because it has not been realized or become virtually certain. Instead, the potential gain should be disclosed in the financial statement notes if material. Remember, since this is being disclosed instead of accrued, the full range is disclosed while also making note of the best estimate, and I talked about that before. Since this gain is probable, they're still going to disclose it, but they're only going to disclose the estimate, which is the full range, $400,000 to $700,000, and they're also going to mention their best estimate. They're going to mention all of it. They're going to disclose all of it in the notes. That's how a contingent gain works. Now let's go to the next question. All right, here we are at question 4. What is the warranty liability Evergreen should report on its balance sheet at the end of year 2? So let's go up to the top. Evergreen Furniture Co. sells high-quality furniture with a 2-year warranty. Based on historical data, the company estimates that 5% of sales will require warranty repairs or replacements, with costs averaging 10% of the sales price. The following sales occurred over the past 2 years. Year 1 sales, $5 million. Year 2 sales, $6 million. During year 1, actual warranty costs incurred were $20,000. During year 2, actual warranty costs incurred were $25,000. Evergreen uses the accrual method for warranty liabilities. So with all that, what is the warranty liability that they should be reporting at the end of year 2? So this is a little bit different. We have been mainly talking about lawsuit liabilities, but now we're also talking a little bit about warranty liabilities. Pause the video, think through this. You could probably figure out with the information that's there. And when you're ready, come back. We will look at the answer together. All right, here we are. The answer is A. $10,000 is the amount of liability for this warranty that they're going to have accrued at the end of year 2. So let's walk through this. Under the accrual method, warranty costs are estimated and accrued at the time of sale. Actual warranty costs incurred reduce the liability. Here's the breakdown. So let's walk through this. For the year 1 sales, they are estimating that 5% of the $5 million of sales will require warranty repairs or replacements, and the cost for that is going to be 10% of those sales. So 5% of the $5 million is $250,000. Multiply that by 10%, and that gives you $25,000 of expected warranty expense. But they only incurred $20,000 in that year. So they have this liability of $25,000. They reduce it by $20,000, and there's $5,000 of liability that they're still expecting to have to pay going into year 2. And that makes sense because some of the stuff that was purchased towards the end of the year might still need to be replaced or fixed in the next year. Now we go to year 2. The estimated warranty costs are again 5% of the $6 million of sales, and that's $300,000. You multiply that by 10%, and that's $30,000 of expected warranty expense. The actual costs were $25,000 in year 2. So the $25,000 of actual warranty cost is applied in this way. First, you would of course apply it to the $5,000. That's the $5,000 liability from year 1. That's going to reduce that to 0. Now there's still $20,000 left of actual expenses. So that reduces the $30,000 expected liability in year 2 to $10,000. So the total warranty liability at the end of year 2 is $10,000 going into now year 3. So that is how you might do a warranty question. Remember, this can also be a contingent liability because they're kind of expecting some of this to happen. So they are preemptively recording a liability because it's probable that this is going to be the case based on previous warranty expense costs. Now let's go to the next question. All right, here we are at question 5. What is the contingent liability that Gizmo Works should report for unredeemed coupons at year end? So let's go up to the top. Gizmo Works Inc. ran a promotional campaign for its new gaming console. With each console sold, customers received a coupon for a free accessory worth $50. The coupon expires at the end of the next fiscal year. Based on past promotional campaigns, the company estimates that 80% of customers will redeem the coupon. During the year, Gizmo Works sold 100,000 consoles at a price of $300 each. By year end, 20,000 coupons had already been redeemed. So with that information, again, what is the contingent liability that they are recording based on unredeemed coupons at the end of the year? This is also not too difficult. You just kind of have to think through this. Pause the video, walk through this, and when you're ready, come back. We'll look at it together. All right, here we are. The answer is C, $3 million. So let's walk through this. The liability for the promotion is based on the estimated cost of coupons that are expected to be redeemed in the future. Here's the calculation. So there was a total amount of coupons issued. Pretty easy to figure that out. There was 100,000 consoles sold, and so that means there was 100,000 coupons that were distributed. They estimated total redemptions to be 80% of those coupons. So $100,000 multiplied by 80% is 80,000 coupons that they're expecting to be redeemed. Now, by the end of the year, there have been 20,000 coupons that have been redeemed. So that means out of the 80,000, 20,000 have been redeemed. There's still 60,000 coupons that they are expecting to redeem. And it looks like I had another typo there. Sorry about that. But again, there's 60,000 remaining coupons that they're expecting to be redeemed. So we get on here. Each coupon costs $50 to fulfill. So 60,000 multiplied by $50 is $3 million. So that's the amount of contingent liability that they have going into the next year because they're expecting to redeem 60,000 more coupons, and each one is worth $50. So again, that's why they're recording that contingent liability, because it's probable based on previous promotions that they've done that this is how much they're going to have to pay / lose when it comes to giving these coupons to people. All right, with that, we've gone over a lot in just 5 questions. Now let's do one more part of the process called pillar topics. Now the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 3, 4, 5 questions teaching you that to have an accrued liability, a contingent liability, it has to be probable and estimable. You've seen these things multiple times throughout the questions. So you know that these are important things. So you take a moment and you write them out in your own words, kind of a summary of the most important things you learned from the questions. And by doing this each day, you are building your own personal repository in your own words, in your own understanding of the most important things you need to know for test day. Now let's go to the pillar topics for this video. Okay, here we are at the pillar topics. First, let's talk about recording contingent liabilities, kind of the basic idea behind it. A contingent liability is recorded, or accrued, when the loss is probable and the amount of the liability can be reasonably estimated. So remember, probable and can be estimated. If the liability is reasonably possible, it is disclosed in the notes to the financial statements but not accrued. Again, there is that difference between probable and reasonably possible. Maybe you might even see a question that's trying to trick you where it says reasonably probable, but remember, think about probable. That's the word you want to be looking for. Now let's also talk about the ranges of estimates that can happen for these different possible liabilities or probable liabilities. For probable liabilities, if a range is provided with no best estimate, the lowest amount in the range is accrued. If a best estimate exists, that amount is accrued. For reasonably possible liabilities, the entire range is disclosed in the notes, but no amount is accrued. Now let's talk about gains. Contingent gains are only recognized in the financial statements when they are realized or become virtually certain. If probable but not realized, they are disclosed in the notes to the financial statements. So remember, you do not record contingent gains unless basically it happened. It's not really contingent, or it's basically 100% guaranteed. Now let's talk about warranty obligations. These can also be contingent liabilities. Warranties create contingent liabilities based on historical data or expectations of future repair/replacement costs. Warranty liabilities are accrued at the time of sale and adjusted as actual costs are incurred, with any remaining liability reflecting future expected claims. And finally, this is another thing you might see, there could be promotions that have contingent liabilities as well. Promotions tied to sales, such as coupons or rebates, can create contingent liabilities based on expected redemption rates. The liability is accrued based on the estimated cost of fulfilling future redemptions and adjusting for redemptions already incurred. So again, these are kind of the pillar topics that we went over in those questions. These are the things that you would need to know when it comes to recording contingent liabilities. And with all that, we've gone over the pillar topics for this video. And before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time. And after you watch that, you're going to want to learn more, and just remember that if you liked this, you can get more of these videos by becoming a Superfast CPA Pro member and getting access to the full 10-question versions that we create for Pro members. So again, watch the webinar, check out the Pro course, and with all that, I hope you liked the video. Make sure to like it and leave a comment if you did, and I will see you in the next video.